The year 2026 has started with a massive shock to the global financial system. While many expected a smooth landing, reports from the IMF and U.S. Federal Reserve suggest a much more complex reality. From a sudden market sell-off to a historic surge in productivity, the American economy is sending mixed signals. Is the United States entering a new era of AI-driven prosperity, or is the $34 trillion debt finally reaching a breaking point? Today, we analyze the data shaking Wall Street and what it means for every worker and investor in America. Let's start with the immediate headlines. The Producer Price Index, or PPI, recently showed a hotter-than-expected increase of 0.5% in just 1 month. This brings the year-over-year inflation to 2.9, a number that caused an immediate sell-off in the stock market. Investors are worried that inflation is stickier than they thought. However, Kristalina Georgieva describes this as a temporary sidestep. Despite this bump in the road, the long-term downward trend of inflation remains intact. The Federal Reserve is still confident that they will hit their 2% inflation target by early 2027. But until then, volatility is the new normal. While other nations are struggling with stagnation, the U.S. economy is performing like a global outlier. GDP growth is accelerating toward 2.4% this year, which is significantly higher than the global average. But what exactly is driving this growth? The answer is productivity. In the third quarter, U.S. productivity grew at a staggering 4.9, the fastest pace we've seen in over 2 years. This isn't just luck. It's the result of massive investments in technology and a workforce that is more entrepreneurial than ever. American businesses are cutting red tape and adopting new tools faster than any other nation on Earth, making the U.S. the absolute leader at the productivity frontier. Perhaps the most disruptive force in 2026 is artificial intelligence. The IMF estimates that 40% of global jobs will be affected by AI. In the US, we are already seeing the first wave of this transformation. High-tech companies are downsizing their traditional workforces while simultaneously hiring for roles that didn't exist 2 years ago. For example, a major fintech firm recently announced it would cut 4,000 employees as AI takes over routine tasks. But it's not all bad news. 1 in 10 jobs now requires AI-related skills, and these positions often come with significantly higher salaries. This transition is creating a tsunami of change in the labor market, shifting workers from traditional roles into higher-value service sectors. The scale of capital flowing into AI is unprecedented. OpenAI has just raised a monumental $110 billion from investors like SoftBank, NVIDIA, and Amazon. Amazon's $50 billion contribution alone has helped push OpenAI's valuation to a staggering $730 billion. This massive influx of capital is fueling technological diffusion, the rapid spread of advanced AI tools across financial, healthcare, and logistics sectors. This investment is the reason why the U.S. labor market remains so agile. Even as some jobs disappear, new opportunities in sports, entertainment, and professional services are keeping the unemployment rate stable at near 4%. But there is a dark cloud over the sunny productivity report. The U.S. federal debt has reached levels that the IMF now classifies as a stability risk. As the debt continues to climb beyond $34 trillion, the cost of servicing that debt becomes a burden on future growth. Federal Reserve Chairman Jay Powell and other officials are walking a tightrope trying to foster growth through technology while managing a debt load that could eventually destabilize the dollar. If productivity growth slows down even a little, the debt crisis could become the primary story of 2026. In conclusion, the U.S. economy remains the best model for the rest of the world. Its private sector is unparalleled in its ability to take risks and innovate. From AI integration to regulatory reform, the U.S. is setting the pace for the global economy. While the risks of inflation and debt are real, the sheer dynamism of the American worker and massive investments in AI suggest the U.S. will remain the world's economic powerhouse. The transition will be difficult for many, especially young workers entering the market, but the overall trajectory remains buoyant.